KSPI.kz officially beat Q2 2026 consensus estimates on both the top and bottom lines.
Yeah, they reported an EPS of $2.87, which beats the $2.78 estimate by about 3.24%.
Right, and revenue hit 1.112 trillion tenge. That translates to roughly $2.3 billion, which is a 15% increase year over year. Management also, reaffirmed their full year 2026 targets across the board.
Exactly. So they're still forecasting roughly 20% marketplace growth, merchandise value grows, 15% payments, total payment volume growth, 15% average net loan portfolio growth, and 15% adjusted EBITDA growth.
But here's the crazy part. Despite that top and bottom line beat, and despite an 18% dividend hike to 1,000 tenge per ADS, the stock actually traded down about 4% on the day, hovering right near $93.92.
It's just a classic textbook divergence between the underlying business volume and near-term market sentiment. The sheer velocity of transactions moving through their ecosystem is breaking historical records.
Right.
But the market is entirely focused on the near-term costs required to, facilitate and sustain that volume.
So for you listening, how does a company beat on revenue, beat on earnings, raise its dividend by 18%, hold firm on its annual guidance, and yet the market still sells off the stock?
Well, the sell-off makes sense once you realize this report just screams investment year. Yes, the top-line transaction volume is phenomenal. I mean, the money flowing through the app is staggering.
But that revenue expansion is kind of acting as a smokescreen, right?
Exactly. It's masking some serious margin compression underneath. When we tear into the consolidated financials, their profitability is taking a hit from two very specific forces. First, they are dealing with elevated domestic funding costs.
In Kazakhstan.
Right, in their core market. And second, they are making massive structural capital outlays to expand their footprint abroad, specifically into Turkey.
So the market is looking at those two factors and basically repricing the stock based on suppressed cash flow today, regardless of what the long-term picture might look like tomorrow.
That's exactly it.
Okay, let's isolate the positive side of the ledger first, just to understand what this margin compression is actually masking. We really need to look at the e-commerce and marketplace segment.
Yeah, digging into the details. Marketplace GMV, the total dollar amount of stuff sold on the platform, grew 15% to $4.8 billion.
But if you strip away the broader marketplace and look exclusively at constant currency e-commerce GMV, it surged 28%.
It's wild. Shoppers are just returning to the well constantly. Annual e-commerce purchases per consumer jumped from 11.6 to 15.8 in just 12 months.
Nearly 4 extra purchases a year.
Right. A jump of 4 additional purchases per user per year across millions of users is a profound behavioral shift. The platform is transitioning from a destination for occasional spending like buying a TV or a winter coat into an ingrained daily habit.
And here is the metric that jumped off the page for me. The monetization of that transaction volume is accelerating significantly faster than the volume itself.
Oh, the take rate.
Yes, their third-party take rate, which is basically the toll KSPI charges merchants just to play in their digital sandbox, expanded by 160 basis points. That's a 1.6% increase, bringing the total take rate to 16.1%.
Yeah, and looking at the breakdown, that spike wasn't driven by them just arbitrarily jacking up basic transaction fees.
No, it was heavily driven by value-added services, or VAS, specifically advertising and delivery revenue, which skyrocketed 49% year over year.
I mean, that 49% growth in VAS completely outpaced the 35% growth in overall constant currency e-commerce revenue.
Yeah.
That really reveals the actual leverage in their business model.
I look at their ecosystem almost like a massive casino, right? KSPI doesn't necessarily care about making a fortune on the basic hotel room, which would be the standard merchant listing fee. They just want the merchant inside the building.
Because they know the merchant is eventually going to play the high-margin slots.
Exactly. You want your storefront placed at the very top of the search results. Pay for premium advertising. You want KSPI Logistics to carry the product directly to the customer's door in under 2 hours. Pay for the delivery service.
It's brilliant.
But let me challenge this entire premise, because 16.1% is an incredibly hefty toll for a merchant to swallow. As an analyst looking at the long-term viability of this platform, you have to ask, at what point does KSPI squeeze these merchants so hard that it becomes unprofitable to use the platform?
Right. Does a 16.1% take rate eventually choke the supply side?
Yeah.
That is the existential threat for literally any marketplace. But the math changes when you analyze the return on investment KSPI is delivering for that 16.1%.
Okay.
You have to factor in the July launch of Casper.
Their personal AI shopping assistant.
Exactly. That piece of technology fundamentally rewrites the merchant's customer acquisition cost.
Right.
Casper rolled out to all eligible e-commerce consumers in Kazakhstan over the summer, and the adoption numbers were just wild.
In less than a month, 20% of eligible users had already engaged with it.
The adoption is impressive, sure, but the conversion metrics are what actually justify the merchant fees. According to management's deck, 80% of conversations with Casper produce a highly tailored product recommendation.
Oh.
And from there, 60% of those recommendations lead the user seamlessly to a specific product page.
Let's break down the mechanics of why that matters so much to a merchant. Usually a merchant has to spend a fortune on external ads, right? Like Google or Facebook, hoping a customer clicks, hoping they browse the digital catalog, and hoping they eventually add an item to their cart.
It is a totally leaky funnel with massive drop-off at every single stage.
Right. But Casper entirely bypasses that leaky funnel. It shifts the Kaspi platform from a passive catalog into a high-converting conversational agent.
Yes. When a consumer opens the app and types, I need a waterproof tent for 3 people that weighs under 5 pounds for a trip this weekend, Casper doesn't just give them a dumb list of camping gear.
It perfectly matches that complex query directly to a specific merchant's VSU.
Exactly. The AI is doing the heavy lifting of matching buyer intent to available inventory with practically zero friction. From the merchant's perspective, their overall marketing costs drop to zero, and their velocity of sales skyrockets.
So they are more than happy to hand over 16.1% of the sale because Kaspi is effectively acting as the world's most efficient zero-salary salesperson for their business.
Precisely.
Okay, so the top-line engine is humming. The marketplace is converting at an elite level, and they are monetizing it brilliantly through AI and delivery services.
Yep.
Which brings us directly back to the paradox at the heart of this earnings report. If the marketplace is that efficient, why was consolidated net income totally flat year over year?
Yeah, they reported 259 billion tenge, or $539 million in net income. Zero bottom line growth.
Right. And because revenue grew 15%, that flat net income dragged consolidated net profit margins down from 26.7% to 23.3%.
Right.
We need to figure out where that cash is leaking.
Well, the leak is concentrated in their financial segments. Payments and fintech. This is where the macroeconomic environment and their structural investments are taking a massive bite out of profitability.
Okay, let's start with the payment segment. Total payment volume, the actual cash moving between consumers and merchants, grew a very healthy 13% to $26.3 billion.
So the usage is definitely there.
But payments revenue only grew 5%. More concerningly, Adjusted EBITDA, their core operating profit for that segment before taxes and, accounting maneuvers, was completely flat.
Yeah, a large piece of that revenue drag is due to the take rate on payments dropping from 1.07% to 1.00%, which management attributed to a long-run shift in product mix.
But the flat EBITDA was heavily impacted by direct technology investments, right? They are pouring capital into rolling out Kaspi.kz.
Their proprietary pay-by-palm biometric system.
It sounds incredibly futuristic, but we need to talk about the mechanics of why a digital app company is suddenly spending millions installing physical hardware scanners in retail stores.
It is entirely about the psychology of friction. In the payments industry, every single second it takes a consumer to complete a transaction introduces a chance for cart abandonment or cognitive second-guessing.
Think about the current process. You pull out your phone, unlock it, open the Kaspi app, select the QR scanner, aim it at the terminal, wait for confirmation. It takes, maybe 10 seconds?
Right. Kaspi.kz reduces that to a single, seamless, physical motion. You literally hover your hand over the sensor and you are done in less than 2 seconds.
So by spending millions on these biometric scanners today, they are betting that removing those 8 seconds of friction will subconsciously encourage consumers to make more frequent purchases over the next decade.
Exactly. The hardware costs are suppressing payments EBITDA today to build a frictionless moat for tomorrow. That is the strategic play.
But the margin compression in payments is only half the story, isn't it? The fintech segment is where the macroeconomic pain is really showing up.
Oh, absolutely. This is exactly where my alarm bell started ringing when I read the earnings deck. The average net loan portfolio is up 18% year over year.
And fintech revenue is up 23%, so the lending engine is roaring.
But adjusted EBITDA for fintech only grew 6%.
Right. If you were growing your loan book by 18% and your revenue by 23%, but your operating profit is only creeping up 6%, the immediate question is asset quality. Like if a traditional U.S. bank presented those numbers, regulators would be knocking on the door.
For sure.
Are they writing junk loans just to force growth? Is the credit quality deteriorating?
The data actually points the other way, which is surprising given the rapid expansion of the loan book. Credit quality remains incredibly tightly controlled. Their non-performing loan ratio, the NPL, is sitting steady at 7.0%.
I have to stop you there, because to anyone accustomed to looking at JP Morgan or Bank of America, a 7% non-performing loan ratio sounds terrifyingly high. A typical U.S. bank considers anything over 1.5% to be a massive red flag. Why is a 7% default rate considered tightly controlled for Kaspi?
Well, you have to adjust for the emerging market context and the specific type of consumer credit they're issuing in Kazakhstan.
Right, it's a totally different environment.
Yeah, these are largely high-velocity, short-term, unsecured consumer loans and buy now, pay later installments. The yields they generate on these products are significantly higher than a traditional mortgage in the U.S.
Ah, so that high yield absorbs the higher default rate.
Exactly. What you want to look at is the cost of risk, which measures the actual capital they are losing to bad debt. That sits remarkably low at 0.7%. Furthermore, their NPL coverage ratio, the cash they hold in reserve to cover those bad loans, is strong at 76%.
So they are absolutely not sacrificing underwriting standards to chase growth.
No, they aren't.
If bad debt isn't eating the profits, what is?
The cost of funding. Specifically, the interest Kaspi has to pay out to its depositors to hold the cash required to fund those loans. Due to the high local interest rate environment dictated by Kazakhstan's central bank, Kaspi's cost of funding jumped a massive 150 basis points year over year.
Wait, from what to what?
It went from 13.0% to 14.5%.
Wow. So their spread is just getting squeezed by local monetary policy. They're still writing excellent loans and generating high yields, but their raw material, the cash deposits from everyday citizens, has become drastically more expensive to acquire.
Right. But management is actively pulling levers to fight back against those high funding costs. In August, they reduced the interest rate they pay out on their 3-month deposit product by a full 100 basis points, a 1% cut.
And that 3-month product accounts for roughly a third of all their deposits, right?
Yeah, making this the first time they've reduced it in over 2 years. It's a massive structural shift.
But as an investor, you have to understand the mechanics of how a deposit rate cut actually flows into the income statement. A 1% cut doesn't instantly repair the margins tomorrow morning.
No, it takes a few months to flow through the existing deposit base. You have to wait for all those existing 3-month products to mature and roll over at the new, lower rate.
So the actual earnings benefit of that rate cut won't fully materialize on the bottom line until late 2026 and into 2027.
Right, and this timing mismatch is a major reason why the stock sold down. The top line looks fantastic today, but the bottom line relief from the deposit rate cut is at least 6 months away.
That domestic deposit squeeze is painful, but it brings us to the second massive weight on their current margins. Beyond navigating Kazakhstan's monetary policy, Kaspi is aggressively deploying capital to expand its borders. They are making a massive, highly capitalized play in Turkey.
This strategic pivot is arguably the most important element of the earnings report, as it will probably define the next 5 years of the company's trajectory.
Tell us about the acquisition.
In July, they officially finalized the acquisition of Rabobank ICE in Turkey, immediately rebranding it to Hepsibank.
This is an incredibly capital-intensive endeavor. They have flagged a $300 million balance sheet investment for this year alone, just to capitalize the Turkish operation.
Yeah.
What I find fascinating isn't just the price tag, but the operational execution. They didn't just buy a banking license to sit in a boardroom and strategize for 2 years. They were already live and piloting embedded finance.
The speed of integration is unprecedented for a cross-border banking acquisition. They have already launched Hepsi shopping loans, which are being integrated directly into the checkout flow of Hepsiburada, the major Turkish e-commerce platform they partner with.
We are talking about real-time credit scoring and loan approval happening seamlessly at the point of sale. Let's unpack the mechanics of embedded finance because it's fundamentally different from a traditional credit card.
Right, with a credit card, the friction happens beforehand. You have to apply, wait for a physical card, carry it in your wallet.
Exactly. Embedded finance means a consumer in Istanbul is shopping on Hepsiburada, adds a new refrigerator to their cart, and right beneath the buy button, Kaspi's algorithm instantly offers them a bespoke 12-month installment plan based on their real-time data.
It entirely removes the psychological barrier of large purchases. Right now, it's just a pilot. Management noted it only accounted for about 0.4% of gross merchandise value in June.
But the infrastructure is live, fully integrated, and set to scale heavily next year.
It is a brilliant strategy for capturing market share, but it carries distinct and multi-layered risks that retail investors need to monitor closely. Expanding into a market like Turkey is not just copying and pasting the code from Kazakhstan.
First of all, you are attempting to integrate a major acquisition in a hyperinflationary environment. The lira is incredibly volatile.
Right. The macroeconomics of Turkey require incredibly agile pricing models and localized risk management. It is a completely different beast than the relative stability they've enjoyed domestically.
Exactly. How do you underwrite a 12-month consumer loan when the underlying currency could devalue significantly before the final payment is even made?
The algorithmic pricing has to be flawless.
Second, they are navigating an entirely new regulatory framework. A single compliance misstep with Turkish banking authorities could grind the entire embedded finance operation to a complete halt.
And beyond the macro and regulatory hurdles, the most significant risk is purely strategic. Kaspi's entire premium valuation is built on the network effects of their super app model. They have achieved absolute ubiquity in Kazakhstan. Everyone uses it for everything.
But the risk in Turkey is relying on management's ability to replicate that localized super app habit loop in a foreign market, right? Where consumer behaviors are different, domestic competitors are already deeply entrenched, and brand loyalty has to be built entirely from scratch.
Exactly. Now, management explicitly stated in the call that they expect no material P&L impact this year from the Turkish bank.
But the reality is that the required capital outlays, that $300 million balance sheet investment, are suppressing their overall net income growth right now. They're intentionally holding back current earnings to fund future international market share.
The business itself is generating incredible cash flows. But instead of letting all that cash drop to the bottom line to pad the quarterly earnings, they're relentlessly deploying it into Hepsi bank capitalization and biometric payment hardware.
Let's bring all of this together. When you look at Kaspi right now, you are looking at a platform that currently commands an astonishing 77 monthly transactions per active user in its home market.
Which is just unparalleled engagement.
They have absolutely perfected the super app loop. You have AI-driven product discovery with Casper lowering merchant acquisition costs. You have seamless e-commerce checkout with friction-reducing biometric payments. And you have embedded financing that instantly funds the purchase.
They own the entire life cycle of the consumer's wallet, from discovery to delivery to debt.
It is a closed-loop ecosystem with remarkable unit economics. The AI and the embedded finance are precisely why merchants are willing to pay that 16.1% take rate. The return on investment is undeniable.
And now they are attempting to export that exact playbook to the massive Turkish market via Hepsi Bank and Hepsiburada.
The upfront capital costs are heavy. At the same time, the domestic high interest rate environment is squeezing their lending margins. The stock took a 4% hit on earnings day because Wall Street inherently hates waiting for a payoff. But if management successfully executes this complex integration in Turkey, and if that 100 basis point deposit rate cut relieves the fintech margins in 2027 as mathematically planned, it raises a completely different, much larger question for you as an investor.
Which is?
If Kaspi proves this model works in a hyper-competitive, complex market like Turkey, they are no longer just a localized Central Asian success story. They become a proven exporter of the super app ecosystem.
Yeah, that changes the game entirely.
You have to ask yourself, at what point does a massive Western tech giant, an Amazon or an Apple, desperate for international growth and struggling to crack the code on global fintech, look at Kaspi's temporarily depressed valuation and decide to just buy them outright?
The moment they prove the model is geographically replicable, their valuation paradigm fundamentally shifts. The temporary margin compression we are seeing today might be the final window where the stock is priced purely on domestic fundamentals rather than global acquisition potential.
That is the ultimate engine of an investment year. Well, if you found this deep dive helpful for cutting through the noise of earnings season, make sure you follow the show. We do this every day, unpacking the mechanics behind the numbers so you can understand what is actually driving the market. We'll see you on the next deep dive.